Hey everyone, welcome back to another dividend investing video. The holidays are upon us and it's hard to believe they're already at the end of the year 2023. Year to date, the S&P 500 is up over 20%. Granted, much of this can be largely attributed to a handful of tech stocks. Dividend stocks, on the other hand, SCHD is down about 3 to 4% year to date. And I'd argue that despite the run-up we had in November in many stocks, a lot of quality dividend stocks are still looking appealing right now, and I'm here today to share with you three in particular that I think are in a compelling spot. Trying to find you guys some value in this insane market. So happy holidays, Merry Christmas, Happy Hanukkah, and with all that said, let's get into these dividend stocks. I'm Nick, and this is the Dividend Growth Income Channel. Thank you for joining me today. I'm not a financial advisor or guru. I'm just a regular guy who wants to share my love of dividend growth investing and building financial independence with passive income. If you could, please do me a favor, smash the like button and subscribe to keep up with future videos. This helps us out more than you can imagine with the algorithm, so we can bring you more quality dividend investing content. The first stock I'm talking about is the Hershey Company, ticker HSY. The Hershey Company engages in the manufacturing and sales of confectionery products in the U.S. and internationally. Products you most certainly know, such as Reese's, Kit Kat, Jolly Ranchers, and more recently, Dot's Pretzels. Headquartered in Hershey, Pennsylvania, their history goes back all the way to the year 1884, and in the year 1900 they began manufacturing that classic Hershey's milk chocolate bar. Year to date, shares of Hershey's are down a surprising 18%. This is certainly an outlier year, not something you would typically see in a low beta consumer packaged goods company. So what is going on? Could this be that opportunity we've been waiting for? I think some of the signs are there. Looking at the big picture, Hershey's has brought a total return of 145% over the last decade. Not quite as impressive as the broader market, but Hershey's was beating the S&P 500 as recently as just this last July until it really started to drop. And we don't necessarily expect a packaged food company to beat the market. We invest in these for the cash flow, the lower beta, hopefully some defense there, right? Except in 2023. But shares today are trading at a forward PE of 18.7. This is a 23% discount to Hershey's 5-year average PE of 24.3. This is as low as we've gotten in 5 years in terms of forward price to earnings, but I think it's been a long time coming. In terms of dividend yield theory, Hershey's is 27% above its 5-year average. Another potential sign of an undervalued stock, at least relative to itself, right? Today's shares are yielding 2.57%, and here's how that works out. Hershey's pays out a quarterly dividend in the months of March, June, September, and December. They pay out $1.19.2 per share for a total annual payout of $4.77. But is the dividend safe? Well, the dividend takes up 48% of forward earnings and 53% of forward free cash flow. Both of those numbers are below 70%. No red flags there, looking solid. Simply Safe Dividends provides us a safety score of 93, very safe, suggesting a dividend cut is highly unlikely. But how are they as a dividend growth stock, you ask? Well, for the last 13 years, they have raised their dividend every year consecutively, and for 34 years, they've gone without reducing the dividend. Now, during that last recession, the dividend was simply maintained as opposed to being raised. The last time they raised their dividend was back in July, and they raised it by 15%. Love those double-digit dividend raises. It's a bit higher than their usual. Their 5-year average annual dividend growth rate is 9%, but the dividend is positioned to continue its growth. Note the upward trend in both charts here, earnings per share and free cash flow per share. This ability to grow free cash flow in this consistent manner is exactly what we want to see if we're investing in a dividend growth stock for the long term. Outstanding shares have gone down over the last decade. They go down by about 1 million shares every year, so not super fast, but they're removing shares every year, definitely not diluting us. And while the debt is a little on the high side, their net debt to capital has been trending in the right direction since 2016, reducing those liabilities every year. Wall Street analysts rate Hershey a buy, a 3.5 out of 5. Out of 24 analysts, 5 rated a strong buy, 2 a buy, and 17 a hold. The average analyst price target is $215.38, representing 16% upside from where shares are trading at the time of publishing. And it wasn't that long ago that this was at that price. So shares of Hershey's have finally gotten to a point where I would personally buy them at this level, no questions asked. Might be a good spot to start a long-term position, maybe start nibbling, as long as you feel confident in this company's position in the snacking industry and your outlook for sweet and salty snacks in general. While there is a focus on more healthy products going forward, who doesn't enjoy a little taste of chocolate from time to time? The second stock is Deere & Company, ticker DE, also known as John Deere. This is an American corporation that manufactures agricultural machinery, heavy equipment, forestry machinery, and more. And they have been at this for a long time, since 1837 to be exact, and they are headquartered in Moline, Illinois. You might be surprised to find out that this tractor company has actually been a steady compounder. Check it out. 2023 has been a down year for DE shares. Year to date, the share price is down over 14%, and today we're much closer to that 52-week low than we are the high. Looking at the total return over the last 10 years, John Deere has brought in about double what the S&P 500 index fund would do. So we have a long-term winner here, up over 407% to the S&P 500's 210%. This is a chance to get shares of John Deere about as low as we've had in the last 5 years. The forward PE is at 12.9, and this is a 17% discount to the 5-year average PE, so shares are valued attractively by this metric. And note that it's also trading at a discount to the industrial sector median as a whole, which is at 18.9. And by dividend yield theory, we're at 13% above the 5-year average with a dividend yield of 1.46%. And I realize this may not look like much, but remember a couple slides back, we had that total return over the last decade at 400%. And if you had bought 10 years ago, your yield on cost would be at 6.5% today on those shares. If you've been holding it and reinvesting it the whole time, that's assuming that. So this is the yield on your initial investment. That's why I don't pay too much attention or concern to whether the stock I'm buying today yields 1%, 2%, 3%. I care more about what's it going to be doing in 10 years. Now, as for how this dividend is handled, it's a quarterly dividend of $1.35 per share, paid in the months of February, May, August, and November, for a total annual payout of $5.40. And I think this dividend is a secure dividend. It takes up 90% of forward earnings and 25% of forward free cash flow. While these numbers are low, they need to be for heavy equipment makers like this. Simply Safe Dividends gives Deere & Company a dividend safety score of 83, rating it very safe, unlikely to see a dividend cut. And this has been a strong dividend growth stock despite the fact that they're inclined to maintain their dividend in recessions, as they did in both 2008 and in 2020, during the uncertainty of the COVID crisis. But look at the bigger picture. 30 years without a dividend reduction, and a very strong 5-year dividend growth rate of 14% on average. So they definitely make up for it. In fact, they've been raising this dividend rather aggressively recently. I really like this. Their last dividend paid out in November was a 10-cent raise from the quarter prior, and the next payment in February is going to be 9% higher. So they raised the dividend by 16% over the last year. That's fantastic. Overall, this is a solid company with conservative management. They keep low debt. They did far better than the broader market in the last recession than the S&P did. While Wall Street analysts give DE an overall buy rating of 3.96 out of 5, with 11 analysts rating it a strong buy, 3 a buy, and 12 a hold. No sells. The analyst average price target for Deere & Company is $423.82, and this represents 16.54% upside from where shares are trading at the time of publishing. DE strikes me as perhaps the most intriguing play in the heavy equipment industry for dividend growth-minded investors, especially with management aggressively issuing these raises multiple times a year. So far, this has been a solid investment. Right now, it's in as good of a place as it's been valuation-wise. I'm sure someone's going to comment, but Nick, you said these are cheap stocks. This is a $360 stock. That is not cheap. But guys, we don't go by share price to determine if a stock is undervalued. This is a function of the number of shares outstanding and the total market cap. They could decide to do a 10-to-1 split. These shares would be $36.88. And if you didn't know any better, then you'd think the shares are cheaper. But that's really not how it works. Now that you know this because you are a viewer. No, you are a subscriber of the Dividend Growth Income channel. You are subscribed, right? The third stock I'm talking about today is Cisco Systems, ticker CSCO. Cisco is in the communications equipment business, the business of keeping our modern world connected. And since their founding in 1984, they have grown into one of the most important technology companies in the world. Without Cisco, much of our world's communications infrastructure simply would not function. They primarily sell switches and routers to connect devices on networks with each other. Their faster growing divisions are their software applications, subscriptions, and security-related segments of their business. Year to date, performance for Cisco shares is about flat, up just about 1%. But over the last month, shares have dropped over 9%, when a few weeks back, the networking giant offered up significantly weaker than expected guidance. But for strong companies, these types of things are often wonderful opportunities. The 10-year total return performance for Cisco shares is 226%, and this slightly outshines the S&P 500's total return of 213%. So it's been solid, and I was actually surprised to see that it's beating the S&P 500, honestly, on that basis. Now, today's shares of Cisco are trading at a forward PE of 12.8. This is a 9% discount to Cisco's 5-year average forward PE of 14.1. Also notable that the 12.8 PE is a huge discount to the information technology sector's median of 22.8. From a dividend yield theory standpoint, the current yield of 3.22% is 7% above the 5-year average dividend yield of 3%. So a slight discount from this valuation, and that is a nice starting yield. Let's take a closer look at how this dividend is handled. Cisco pays out a quarterly qualified dividend of 39 cents per share in the months of January, April, July, and October for a total annual payout of $1.56 per share. The next ex-dividend date of January 3rd, still a few weeks away from the time of publishing here at least, so for that next dividend payment of January 22nd. And this dividend is easily covered by Cisco at 41% of forward earnings, 40% of forward free cash flow. Nice. Cisco has a dividend safety score of 91 at simplysafedividends.com. By the way, they provide a lot of these graphs I'm showing you guys, Simply Safe Dividends, projecting that a dividend cut is highly unlikely with a very safe dividend. Cisco has been paying and growing this dividend for 12 years, and it's growing not at a super fast pace, but growth has been steady and reliable at an average annual growth rate of 4% over the last 5 years. Cisco shareholders have the benefit of a solid buyback program as well, where the outstanding share count has been reduced by over 22% in the last decade. But what I like most about Cisco is they're a company that has more cash on hand than debt. That's right. And in this era of high interest rates, that is double awesome. So Wall Street analysts, they give Cisco a rating of 3.59 out of 5, rating the stock a buy. Out of 27 analysts, 8 rated a strong buy, 1 a buy, 17 a hold, and 1 a sell. And it looks like there is some potential upside still to come with an average price target at $54.60. That's almost 13% upside. And I think this recent drop has made for a nice opportunity. Cisco is a stock that I do hold in my portfolio. For full disclosure, I've been purchasing it heavier since it dropped, a few weeks back. Opportunities come to those who are patient. So if you want to see the other stocks that are in my public portfolio that I started here on the channel a little over a year ago, go ahead and click into this next video where I sum up the progress we're at in the account thus far. I have this with Fidelity. More to come. Thanks for sticking around, my friends. And until next time, keep investing.